slides?
Yep, I'll take care of it for you.
Okay, thank you. Okay, in the interest of time, I think we're going to go ahead and get started. Welcome to Transitioning into Practice. I'm going to hand it over to Dr. Karen Miller, who is going to do the welcome and then transfer over to our presenter for the evening.
Yes, welcome. It is my pleasure to present Chad Kelley, Certified Financial Planner. He has worked at Utah Medical Association Financial Services helping physicians since 2012. He's passionate about getting to know clients, learning their story, and then helping them build a roadmap to meet their financial goals. Chad works with physicians from residency to retirement. He has unique insights into many of the challenges that confront you guys. Chad's expertise includes debt reduction, insurance, investment management, and comprehensive planning. Oh, I'm sorry, that was supposed to be the last slide. I just read the wrong intro. Oh, I've got this all wrong, sorry. Now the housekeeping matters are, your microphone was automatically set to mute when you entered the webinar, but we ask that you please keep your cameras on unless stepping away. As you can imagine, it's nice for our presenter to see a live audience. If you have questions, please enter them in the chat box and our team will make sure they get addressed during the Q&A or in follow-up with you. And let me just say that this evening's presentation is due to the generosity of the University of Utah Medical Group Community Physician Group. That is responsible for both this seminar and some resources we'll send you following the series. I think I got back to what I was supposed to say at the beginning. And so Chad, thank you for your time this evening and welcome.
Thank you, I appreciate the introduction. I will share my screen here and we'll jump into it. Let me get it pulled up here. All right, can everyone see my first slide there? Some head nods, yeah. Okay. So thank you for the introduction. Like was mentioned, my name is Chad. I work for the Utah Medical Association. So the UMA owns a financial service group, and our group, as you can see here, some of the details, we were started in 1993. For those who are maybe in the medical industry or familiar with our story, back in the 80s here in Utah, there was a number of physicians who got caught in some bad investments and ultimately lost a lot of money. It caused the medical association to say, hey, let's set up a financial service group that we can at least bounce ideas off of and trust that they're not taking advantage of us. And that's ultimately what drove our beginning is fraudulent activity in the investment world that spurred the need for maybe some unbiased financial advice. Our office is in Murray on 45th South, so about 15 minutes from the university. We manage about $1.3 billion of physician money. And so part of that's made up of retirement plans. So there might be a physician medical group and we help manage their 401k or their retirement plan. Some of that's made up of individual client assets, whether clients have IRA accounts, brokerage accounts, trust accounts, whatnot. We can help manage those, do the trading and rebalancing. And so that's kind of how that $1.3 million is made up of: retirement plans, individual client assets. There's about a dozen of us in the office. As was mentioned, I've been with UMA Financial Services for about 8 years. I'm married, have 3 kids. So if I look sleep deprived, it's because the children are running the household. And so those of you who have kids understand. But we'll kind of jump into it. So some of the topics we're going to talk about today are things that you should maybe think about now. Some of the things we talk about are things that you should think about in a couple of years. Some of the things we talk about are things you'll think about later on down the road. But I think it's good to kind of start building a game plan, put together a roadmap of things that you should at least be aware of, and building from there. So part of the resources that we have, and you can find this on our website. I'll list our website on the last slide for those of you who, our website is UMAFS, as in financialservice.org. But there's a tab under the library where you can listen to podcasts. So we've got a podcast. You're going to hear more of my voice. I'm on the podcast, and we pick different financial topics and we go more in depth. So some of the things we talk about today are podcasts that we have available to you that you can get a 15 or 20 minute deeper dive into that specific topic. So feel free to jump onto there. You can download them through the website. You can also download them through wherever you get podcasts, whether it's Apple Podcasts, Google Podcasts, Spotify, Stitcher, wherever you download them. You can find ours, just search UMAFS and pull up our podcasts. And for those of you, unless you love finance, you might want to have a heavily caffeinated beverage. Otherwise, it'll put you to sleep. So feel free to take a look at that. To kick things off, I want to take a look at this slide that we have. We call it our retirement equation. So when it comes to financial planning, there's a lot of ways that you can focus your energy and your mental capacity. And we're going to talk about where it maybe makes sense to focus. So the circles on the right, the yellowish gold colored ones, I guess. Let's start with those. So the first one is market returns. And as you can see, the arrow states that this item is out of your control. Policy regarding taxation, savings, and benefits. This largely is out of our control as individual investors, right? As much as we want, we can pound the table and yell at the computer. We can't make the market go up. We can't make the market go down. It's largely out of our control. Oftentimes, it feels like taxation, maybe policies concerning student loan forgiveness. And we're going to talk a little bit more about that. Some of those things largely as an individual are out of our control. We do have some capacity to vote in different representatives, I guess, political leaders who might sway some of these decisions. But as an individual, it's common for investors to focus a lot of their attention on market returns. And that's the exciting part of financial planning, it feels like a lot of times. That's why a lot of people want to focus on that. But if we focus too much energy on that, it can drive you mad, right? Because once again, we can't make the market go up, we can't make it go down. You might say the market's overvalued. There needs to be a correction. It may or may not happen, right? And so let's jump to the blue circles towards the bottom. So the items that you have some control over, your longevity, ultimately how well you take care of yourself, I guess will determine how long you live, which is important because you don't want to run out of money. Employment, earnings, and duration. So this is something that you have some control of. Maybe how you specialize, how long you work, where you take jobs. You do have some control over how much money you're going to make, what career, profession you go into. Are you a dual income household, single income household? These are all factors that play into it. But the items, the purple circles that you do have total control over, saving versus spending. This is something that you do get to control. How much money you're spending versus how much money you're putting aside for retirement. The other one is asset allocation and location. So asset allocation, how do we invest our money? Are we all stocks? Are we all bonds? Are we all real estate? These are the sorts of things that you do have control over, and they will have a big effect on your outcomes in retirement. Asset location is important as well. Part of what this means is you could tie your wealth up into things like real estate. There will be certain effects that you feel if all you own is real estate in your portfolio. It could make sense to own certain asset classes in specific types of accounts. Like maybe you own REITs, real estate investment trusts, inside of a Roth. rather than a brokerage account, because maybe REITs spin off ordinary income capital gains. And so you want to have that asset class inside of the tax advantaged account. We'll talk a little bit more about this, but where you own certain asset classes and where you're investing your money is important. And it's something to start thinking about now. You might say, right now I have little to no savings for retirement. That's okay. But the key is that you kind of put it on the radar, start developing a roadmap, and so that when your income jumps, you have a game plan. Once again, like it was mentioned, if you have questions, feel free to put them in the chat box, and we'll either get to them as we go through the presentation, or else we can get to them in the Q&A. But we'll jump here to the next slide. So this is the $1 million question. How much money do I need to retire? When I ask clients this, or groups of people that I'm presenting to, I get everything from like $1 million to $10 million. And the answer is, yeah, that's probably an accurate range. Somewhere in that range, right? Now the question is, where in that range? Is it closer to 1 million? Is it closer to 10 million? Well, the short answer is it's going to depend, right? And so these are some of the considerations or things to think about that'll determine, are you closer to the 1 million area or 10 million? How much money do you want to spend each year in retirement? Do you want to retire before you're 65? Certain specialties, it seems like as we meet with them, everyone in the specialty has a desire to retire early or start tapering off early. Some people want to work as long as they can. And so these are the sorts of questions you think about, right? Because it'll affect how much money you need to save to get to that point. Are you going to retire in San Francisco? Are you going to retire in St. George, Utah? Because there's a big price difference in cost of living, right? Oftentimes people say I might have inheritances coming my way, or maybe children that I'll need to care for financially into retirement. These are the sorts of things that'll help you determine, what's that magic number for me. Another $1 million question we get is, should we plan on Social Security? So there's a lot of skepticism around, am I going to get Social Security? So every time you get your pay stub and you see that little line item FICA, I don't know who FICA is, but he's been taking my money for a long time, and that's Social Security. You're paying into the Social Security system. So every paycheck, a little bit of your income goes in there, and that'll increase when your income jumps from a resident salary to an attending physician salary. And so the idea is when you retire one day, you'll get money back from the Social Security program. Now, those who are familiar, the Social Security program has been overhauled a couple times. During the Ronald Reagan administration, there was some big changes, and we could see similar changes going forward. Likely what would happen if changes were to happen to Social Security is they just essentially dangle the carrot out farther, meaning they push retirement age farther out for you. So your benefits would just be pushed out farther. So, but the short answer is we feel like Social Security will be there. It may look different than it does today, but we believe it'll be there. So when you think about income sources in retirement, I think it's okay or safe to say I'll plan on something. We can do conservative projections for you if you want. And, but yeah, no, we think it'll be there to some capacity. So this is a chart that you guys will understand, life expectancies. So JP Morgan, they're a big money managing company. They put this slide together. And so one of the key piece of data I want you to take away from this, it says if you were 65 today, the probability of living to a specific age or beyond. Now, if you look at the chart right here, my mouse is over it, where it says 90 years. Basically, if you're married or a couple, both are alive at age 65, there's a 48% chance that one of you is going to live till 90. And so when we do financial planning projections, you need to take that into consideration, that your portfolio needs to last 30 years, right? Some people look at this data and say, no one in my family's lived past 85 ever, right? But you don't want to be the one to break the cycle and live to 95, but run out of money at 85, right? And so these are the sorts of things to kind of think about. I need my portfolio to last. I need to determine how much money I need in retirement. Where's that money going to come from? There's several calculations that people use in the industry to determine how much money do I need for retirement. One of the popular ones is, we call it the 4 to 5% withdrawal rule. So the idea is that you can pull 4% of the total value of the portfolio every year in retirement to live on and not deplete your money, meaning it's not going to run out by the time you retire. And so, you can use that to kind of back into, what's the lump sum amount that I need to live comfortably off 4%. That's one way to think about it. There's some calculations out there called Monte Carlo simulations. And these are calculations we can do. They're often run in software programs that are expensive. And we have some software that we use with our clients and projections to determine, are you on track for retirement? And they run these Monte Carlo simulations. Whenever I hear the term Monte Carlo, I always think like it sounds like gambling, but there's actually calculations that go into it. And so the software looks at the last 40 years of returns in the market, and it projects out the next 40 years and says, based on trends and returns that we've seen in the past, given how much you're saving and how much you're going to spend, what's the likelihood of success? And it creates a percentage of likelihood of success, with 99 being the highest, 0 being the lowest. So that's one way to think about it. Funded ratio calculations is another popular one. This is also oftentimes used with software, and we have some of that software that we can run that. Another rule of thumb is people say you need 20 to 30 times your annual spending is how big your portfolio needs to be. Once again, that's another big range, 20 to 30 times. Whether your portfolio is 20 times your annual spending or 30 times, that's a big difference. And so these are some of the calculations or things that you can kind of use to back into it. We use a combination of all these, but our goal is to help people arrive at a number, right? How much do I need to save today? Because for a lot of people, they feel anxiety over retirement, saying, I know it's out there. I don't know if I'm on track. I don't know how much more I need to be saving. Am I saving too much? Hopefully, we as the advisors can help you put pen to paper and bring some clarity to that question. This chart kind of illustrates or plays off that 4% withdrawal rate that I mentioned and talked about. So if we look at the chart on the right, the lines represent your portfolio or spending from your portfolio. So if you started with $1 million portfolio, over the course of 30 years, a 30-year retirement, that top line represents you have a 40-60 allocation, so 40% bonds, 40% stocks, 60% bonds is your portfolio allocation, and you draw 4%, you're gonna end with, at 30 years, about the same size, $1 million portfolio. That's a sustainable withdrawal rate. Now, if you are the middle line and your portfolio is 20% stocks, 80% bonds, and you're more conservative, bonds are more conservative than stocks, right? And we draw 4%, you're still gonna have enough money, but it's you end up with what, like $700,000 at the end of the plan. And if you remain in cash the whole time, you don't invest your money, and you draw 4%, you're gonna run out of money at 25 years. So retirees need to have a sustainable withdrawal rate, and they need to be properly invested. And these are the sorts of things that we can help you out with. One of the things that I maybe should have clarified a little bit better. So we meet with all physicians who are members of the Utah Medical Association. You guys are all part of the members of the Utah Medical Association. The program, the university pays for your membership. So congratulations. Part of that means that you can meet with us for free. A lot of advisors have a financial planning fee and an asset management fee. We don't have a financial planning fee. So for you to consult with us, it's free. So I do lots of meetings with residents, and we answer these sorts of questions and talk through these sorts of things. And it's free to kind of go through these scenarios for you. Another chart that I think is valuable for you to look at and think about, this helps you determine what percentage of your income should you be saving to be on track. So you can find your projected income, maybe as an attending physician across the top. It might be off the charts here, and your age down the left side. So at what age are you going to be done with residency? it could be 30, could be 35, could be sooner, could be later, right? So if we said, oh, you're 30 and you're going to be making $250,000 a year, 19% is the number. And so kind of a rule of thumb for most physicians is physicians need to save at least 20% of their total pay. Now, when I say total pay, I mean the income you earn before you pay taxes, because your actual take-home pay is your net amount, or the amount that you have left over after you pay taxes, right? So if your total compensation is $250 and you need to save 20%, what is that, $50,000 a year you need to be saving to be on track for retirement. And what that does is it sets you up so that one day when you retire, you can continue the same lifestyle you've been living as an attending physician into retirement. You're not having to scale way back. That's always a hard conversation to have with someone and say, based on how much money you have and how much money you're spending, you're going to have to live on less in retirement or work longer. Or we find some risky hobbies for you and shorten your life expectancy. Like maybe you pick up skydiving or smoking, I don't know. But these are the sorts of conversations that we have with people, is help them determine, am I on track? Do I need to save more or less? But kind of a good rule to keep in your mind is as you transition out of residency, 20% is kind of the number. And so right now as a resident, you might say, I would love to save 20% of my resident income, but it's just not possible, Chad. That's okay. Most physicians can make it work. Is if you save what you can now, it might be 10%, could be 8%, could be 15%. Save what you can now into the 403B, and we'll talk about that a little bit. And then as you transition to an attending physician, hit the ground running, saving 20% at least. Those who say I want to retire earlier, it might be closer to 25%. But those are the sorts of nuts and bolts that we can sort out with you one-on-one. Here's some back the napkin math here. So I just made some assumptions. If you save $50,000 a year for different time periods, 20, 25, 30 years, 35 years, and you earn 6% on your money through that time period, I listed kind of the lump sums you'd roughly end up with. So, if you said I'm going to work for 30 years, save $50,000 a year, I earn 6% on average, you almost have $4 million, which is a lot of money, right? So if you say, okay, if I draw 4% off of 4 million, was $160,000 a year or so, roughly. For a lot of people, that's plenty. That seems like plenty for, right now when you're looking at resident salary and maybe the lifestyle you're living, you think, yeah, that's plenty, that's fabulous, right? But for a lot of retirees, maybe it's $8,000 a month, maybe it's $12,000 a month. Could be somewhere in that range that you need. And so this kind of gives you an idea. If you start hitting the ground running, saving adequately, you can amass a big chunk of change. The mistake we find is that people delay saving, and they might wait 5 years after residency before they really start saving because they really want to get in the house, they really want to upgrade their automobiles or things like that, and they delay saving, and then suddenly they have to save a higher percentage of their income, and it gets more and more difficult to do at that point. And so kind of some rough numbers to keep in mind, I guess, here. We'll talk a little bit about some ideas around investing. As you transition out of residency, you're going to see a lot of different retirement accounts potentially. So those who work at the U as attending physicians are eligible for the 401A, 403B, 457. If you jump on Intermountain, you might be eligible for the 401K, 403B, 457, and possibly a pension. If you jump on at Revere Health or one of the other medical groups here in the state, you might qualify for any combination of these. And so why it matters is because the more accounts you have available to you, oftentimes it's easier to save for retirement. So hitting that 20% gets easier if your employer puts some of it away for you or has multiple accounts that you can save into. Whereas if you said, hey, I'm going to jump out as a solo practitioner, maybe the trade-off is you make a little bit more money, but there's more responsibility on your shoulders to save for retirement because you don't have multiple accounts to save into. So these are the sorts of things to consider. Oftentimes as people weigh different job prospects, it could make sense to say, maybe I compare the two job prospects from a retirement standpoint. I look at who has the better benefit available, right? Who has who's making the better profit sharing contributions or matches for retirement? Those are the sorts of questions that we can help you out with. I'd be happy to kind of walk through those scenarios with you. Right now, you're eligible for the 403B through the residency program. Unfortunately, the U does not do any contributions to your 403B, so all contributions are your contributions. You have the option of saving traditional or Roth. That's how your contributions can go into the account. Traditional contributions go in pre-tax, meaning that money will grow and continue to grow until you pull it out in retirement, and then you pay taxes on the back end. If you put in money as Roth, you pay taxes now, and all growth is tax-free. So while you're in a potentially a lower tax bracket now as a resident, maybe it could make sense to save as a Roth. So contributions that you put into the 403B, you could save as Roth. Right now, the limit is $19,500 per year that you can put in. Once again, like I said, if you might be saying to yourself, Chad, if I put nearly $20,000 of my salary into the retirement account, we're going to be eating beans and rice every day. I get that. And so, the short answer is, maybe you save a lesser amount, but we feel like it's good to get in the habit of saving. So saving into the 403B could be a good option now. But we can kind of sit down and game plan and say, as your income increases, maybe you hit the ground running, saving into a number of these or any combination of these. And they all have different rules and contribution limits. We can kind of help you understand and walk through and build a game plan around. So this chart's busy. Across the top, and a lot of this information is small font, I apologize, but you see years listed from 2009 to 2018. Now, the different boxes represent different investments or asset classes that you could invest your money in. People typically think of investing as stocks and bonds. Well, within stocks, there's different asset classes, like, am I investing in large companies? And am I investing in small companies? Am I investing in commodities like oil prices? Or am I investing in real estate, things like that? So each of these boxes represent different asset classes. Now, the boxes towards the top were the higher performing asset classes for that year. The ones at the bottom were the underperforming asset classes for that year. So looking at this, it's kind of crazy, right? You might say there's no pattern to it. It's somewhat random. So is Chad's job to pick what's going to be the best performing asset class next year? I've got some tough news. We cannot tell the future, right? I don't know what the best performing asset class is going to be next year. No one really does. And so the best approach might be say, okay, rather than trying to handpick or guess what's going to be the best performing asset class, maybe I just make sure that my portfolio takes in a little bit of all of these, or maybe we overweight to some of these. And we, rather than trying to pick it, we say that, we're gonna do maybe more like a little bit of index investing or passive investing, saying we're not going to try to pick the best performing asset class because ultimately our crystal ball is broken. We can't look into the future. So we're going to set up a diversified low cost portfolio. And for most people, that's probably the best approach, because as you can see, it's difficult to guess what's going to be the best performing because it's fairly random year to year. More healthy portfolio could look something like this. This is an example. So a portfolio that has US large caps, maybe a larger portion of that, some small cap stocks, and different asset classes. This could be a more healthy, diversified portfolio than saying, I'm going to put all my money in just one of those asset classes and hope that it's the best one, because that can be a painful game if you're wrong. This slide here helps us understand the importance of, once again, we can't predict what the best performing asset classes are going to be in the years ahead. We might have some best guesses based on economic indicators and whatnot. And so a lot of people say, I want to try to time the market. Like, hey, I think I saw some headlines today that make me nervous. I'm going to move to all cash in my portfolio. Once the dust settles, I'll move back into the market. So essentially I'll sell here and get back in at a lower cost. Buy low, sell high, right? And so this slide says that if we would have had $10,000 back in January 4th, 1999, and we invested it in the S&P 500, so the 500 largest companies in the US. So companies like Microsoft, Oracle, Intel, the 500 largest companies. If we invested that $10,000 from 99 up to December 2018, that first bar shows that our return would have averaged out to 5.62%. Our money would have nearly tripled over that time period. Now, say that we handpicked and removed the 10 best performing days in that 20 years, just the 10 single best days. Your portfolio would have only grown $4,000 or $4,800. Now, if we removed the 20 best days over a 20-year time period, you would have had a negative return. And so it's difficult to know when those 20 best days are going to occur in the next 20 years. Kind of the classic story that comes to mind, we had a client who, the last presidential election go around, so the Hillary-Trump election, I received almost daily phone calls from this client saying, Chad, I'm nervous that if Trump gets elected, the market's going to drop. He will drive us into a recession. And I said, okay, that's a valid concern. You know, a lot of the beliefs in the economy at the time was that there was some hesitation around Trump getting elected. So I said, well, the flip side is if we guess incorrectly and we move your portfolio to cash and the market jumps, we're going to be in a world of hurt. Well, we had this ongoing conversation for days and days. Well, leading up to the election, he said, well, ultimately it's my money. And I said, you're right. Ultimately you can decide what you want to have done. And he elected to move the majority of his portfolio to cash. Well, who remembers what happened? Most people were surprised. Trump was elected. The market jumped, and it jumped big time, right? And this was back when the Dow Jones Industrial Average, which is an index that tracks where the market's at, was at like 18,000. Today it's bumping up against 27,000. The market never really dipped back down to that point, and so that it did before the election. And so following the election came the panicked phone call saying, Chad, we moved to cash and the market's jumping. What do we do? Said, well, maybe we jump in because the market could keep running. And he said, no, let's wait until the market pulls back. Well, it never pulled back, like I said. And so it's a difficult game to say, I'm going to time the market. You have to be right on the exit point and the re-entry point. And that's hard. It's hard to guess. Some people get it right and they look brilliant. Other people get it wrong and they look like fools, right? And so probably the best approach is to say, maybe I have a correctly allocated portfolio so I don't have to try to time the market. Every time I see a scary headline, I'm not having to call up my financial advisor or log into my accounts and try to time it, because that's difficult. It's time consuming, and oftentimes we get it wrong. And if you miss some of the best days over the time period, oftentimes big returns come on the heels of big drops, right? So this slide kind of illustrates the importance of staying invested, having a good game plan, and staying in the market. You know, for the sake of time, we're going to jump past this one. This slide here, so it looks at the returns year to year from 1926 to 2012. So the dark blue boxes represent positive returns. Lighter blue represent negative returns. So as we can see over that time period, 1926 to 2012, 75% of the years were positive return years. 25% of the years were negative return years. And so oftentimes you can see that 1931 was the worst performing year. Well, 1933 was the best performing year. So it's easy to say, this year's a good example. So we started, the market was high. January and February, the coronavirus started hitting the news and started scaring investors. The market pulled back, right? Till about the last week in March when it kind of hit the bottom. Now, if you would have sold at the bottom and not stayed invested, you're probably kicking yourself now because the market's come back, almost recovered completely. And so oftentimes, real quick, I guess if you look at August was one of the best performing months we've had in the stock market in years, right? So if you were in cash during that time period, you would have missed out on a big month right on the heels of big drops, right? So staying in the game, staying invested is oftentimes a good game plan. 3/4 of the time, historically, the markets move upward. And so that's something to keep in mind as an investor. So having a game plan, having someone you work with, or whether you do it on your own or someone you work with, is important. We're going to talk a little bit about insurance. Some of these concepts or topics have been touched on and will be touched on maybe in other presentations, but one thing to kind of put on the radar is umbrella insurance. So umbrella insurance is often called catastrophic or liability insurance. So you'll have renters or homeowners insurance policies. Those policies will have limits. So say you got in a car accident that you caused and someone was suing you for an amount above and beyond your auto coverage. You could be on the hook personally for the amount above your auto coverage. This is where the person suing you calls our friendly local personal injury attorneys, and they sue you because your name says doctor, and all doctors are made of money, right? That's what people think. And so an umbrella policy covers above and beyond home and auto renter policies. They sell in $1 million increments. So if you own $1 million policy, you'd have $1 million of additional coverage above your other policies. So this is something to put on the radar, probably something you should have certainly as an attending physician. Most residents probably could get by without it, because most people, if they were to sue you and realize you're a resident, are realizing they are not making big bucks yet. But certainly as you transition to a higher salary, something to think about. I tell all my clients that one day you're going to make more money. All my clients who are residents, when you make more money, colors are going to be more vibrant, food's going to taste better, music will sound sweeter, but it comes with additional challenges, right? And one of the additional challenges, you have additional liability because your name says doctor, and so you kind of have to protect yourself. Disability insurance is important. Your biggest assets is your earning potential. Over the next 30 years, you're going to earn millions of dollars. And so you want to be able to ensure that. If you were to become disabled or injured, are you still going to earn income? Oftentimes you can if you have a good disability policy. So right now, you're participating in the group disability policy. So if you became disabled right now, you would get roughly 60% of your resident salary. Now, if you start crunching the numbers, 60% of your resident salary is not a huge number. So my best advice is don't become disabled as a resident, because if you have a long disability, 20 years, you're only going to get 60% of your resident salary, not your salary you're going to earn in 4 years. And so, but it is important as your income jumps that you have a good policy that covers that higher income. Now, you might get coverage for disability through either a group disability insurance policy or a private policy. It could be the case that you're jumping on with a group that has a great policy and you don't need to go out and buy a private policy. But it could be the opposite, that maybe their group policy is bad or they don't have one. And so you need to look at picking up a personal policy or a combination. Once again, it's going to be kind of case by case, and we'd be happy to kind of walk through it with you. We do disability insurance. We can run quotes, help you determine if it's a good policy or not. Oftentimes people come to us and say, this other advisor is selling me a policy. I want you to look over it, Chad, and give me a second set of eyes on it. Tell me if you think it's a good one. I can look at it real quick and say, it's a good one, or it's a bad one. And we'll be honest with you. One thing you want to make sure your policy covers is your specialty specifically. If you are a physician that needs use of their hands and you lost a hand in an accident, the last thing you'd want to have happen is the insurance company to say, technically you're not disabled because you can flip burgers with your other hand at the burger joint down the street. That would be the nightmare situation, right? You want to state specifically that if you can't practice as a surgeon or whatever your specialty is, that you are disabled. So there's certain wording and things in these disability policies that it makes sense to review and make sure they're structured properly. We'd be happy to take a second look at that with you. Disability insurance is a big hot revenue maker in the industry. I can't remember it. So one thing that's unique about UMA Financial is all of us in the office are salaried, which is kind of unique. Most financial advisors work off of commission, meaning they get paid as they sell you something. So disability insurance is a big revenue generator for individuals, for advisors. So it's going to be the case often that you get financial advisors who want to be your best friend and want to breathe down your neck until you buy an annuity or a life insurance policy or a disability insurance policy. Sometimes it can be the right fit. sometimes they're telling you it's the right fit because that's how they get paid. Whereas, where I'm on salary and my colleagues are on salary, if you walk through the door and, we feel like it aligns our interests more with yours. So we're going to give you more of a straightforward answer that's not influenced by how Chad gets paid. So that's one thing to kind of consider. Life insurance is another popular one. Two main types of life insurance: term and permanent. Permanent's often called whole life insurance or universal life insurance. Term insurance is pretty straightforward. You agree to a policy for a set number of years, maybe 10, 20, 30 years, with the understanding that you pay the annual costs and they will pay out a lump sum to your beneficiaries if you die. Pretty straightforward. If you stop paying, the policy lapses. After that time period that's set lapses, the policy's gone as well. Whereas a permanent insurance continues past retirement. It keeps going until you die. So you could buy a policy at age 30 and have it until you die at 90. Permanent insurance policies are more expensive because the insurance company is guaranteed they're going to pay out at some point because you're going to hold the policy until you die. Permanent insurance policies are more complex. They combine a little bit of investing along with insurance. And so your premiums or the cost you pay is much more expensive. Kind of a blanket statement. Most physicians' term life insurance could probably the best fit, but there can be situations where permanent or whole life insurance is the right fit. The majority of the time, term is the right fit. Once again, case-by-case basis, we'd be happy to kind of walk through that with you. Student loans, there's been some other presentations on this as well, and I encourage you to listen to them. I just want to echo that the best thing to do is to have a game plan. For most people who are going to work for a nonprofit, most people are shooting for the public service loan forgiveness. The basic idea is if you make 10 years worth of payments or 120 qualifying payments while on an income-driven repayment plan, in theory, at the end of 10 years, the balance is forgiven. Now, if you're going to jump into a private practice group and you're not working for a nonprofit, you're going to want to look at likely refinancing your loans because your loans probably are at 6 to 7%. You can refinance them down to 3 to 4%. Now, you know who these refinancing companies are. They mail you all sorts of junk mail. SoFi, Lending Tree, Laurel Road. These people want to be your best friends, and they will hold your hand through the process of refinancing your loans down to a lower interest rate. So if you end up working for a for-profit private practice group, refinancing is probably the way to go. If you're doing a nonprofit, 10-year debt forgiveness could be the best way. Once again, case-by-case basis. I encourage you to look at the AAMC loan calculator. This calculator allows you to input your current loans into the calculator, and it'll help you build a good repayment plan. And it oftentimes recommends a good repayment method. Most residents are on the REPAY income-based repayment structure. REPAY has some interest subsidies that the others don't, meaning some of the interest you accrue is forgiven through that structure that you're not going to get in other ones. But once again, your family dynamics can play into that. Are you married? Do you have kids, dependents? How much you have in loans? So it's probably best to just go to the loan calculator. You can Google the AAMC loan calculator and input your loans and walk through that. We have a podcast on this, and so you can jump into that and take a listen. Last slide here. Residents oftentimes say, hey, I might not be a homeowner now, but I want to buy a home one day. What advice do you have? Kind of our rule of thumb is that the balance of your mortgage probably should not exceed 2 to 3 times your annual income. So if you make $300,000 a year, your mortgage probably shouldn't be larger than $900,000 a year. Now, if you have a down payment that can go above and beyond that 3 times rule, but probably the biggest mistake we find young physicians make is right off the bat buying a house that's just too large or too expensive, I should say. And they enslave themselves to a mortgage payment, and that dwarfs their ability to save for retirement, to travel like they want, and I guess life's all about prioritizing what you want to focus on. Some people might say, I really want the dream house right off the bat. If that's the case, maybe you just have to be okay with working a little bit longer, uh, traveling less. I don't know. Everything kind of comes at a compromise, right? And so, kind of a general rule of thumb, 2 to 3 times. This can get tricky if someone says, like, hey, I'm moving to San Francisco versus, hey, I'm moving to Idaho. Different markets have different prices. And so this is something we can kind of talk through and think through with you. Physician home loans are a popular way that physicians can get into a house with little to no down payments. So residents might finish their training and say, I have $10,000 in my bank account, but I do make $300,000 a year and I want to get into a house sooner than later. A physician home loan would help you to do that. Physicians are groomed to make debt payments. Imagine that. You have, from day one, been making student loan payments and you're getting for a while. And so physicians very seldom default on debt. They're very good. People love to lend money to physicians because they have high income and they always make their payments. And so they have the physician home loan structure available to you. That's something you could consider. And so here's my contact information. So once again, you're members of the Utah Medical Association, which means that you can sit down with us as financial advisors and we can meet and we'd be happy to walk through any of these questions or other financial topics with you and help you understand how this applies to you and help you build a game plan. We work with everyone from residency to retirement. And so we've kind of seen the spectrum. There's a good chance that the questions you have, we've seen before. We do have clients in 34 states. The majority of our clients are in Utah, but oftentimes people say, hey, Chad, I met with you before. I'm actually moving to Texas or wherever. I'd like to continue that relationship. Is that possible? The answer is yes. And so we can continue that. And so right now we're doing all of our meetings with our clients via Zoom and conference calls. And so you moving out of state isn't an issue. But no, with that being said, we'll kind of open it up to general questions. I'm not sure how we want to do this, but
So Chad, we'll go ahead, and anybody who has questions, feel free to unmute your mic and ask a direct question of Chad. While folks are doing that, we had one question in here about not being aware that the U residents were eligible for a 403B and created a Roth account through Fidelity.
yeah.
Is that an issue?
Yeah, Chad, that was my question.
Yep.
I didn't know that 403B was a thing and that I could contribute to it, that, our employer offered it.
Yeah.
And so I just went on Fidelity and invested some money, actually my wife's student loan money. And so not a lot, but I just created this Roth account on my personal Fidelity account. Yeah. And put money into it and selected what funds I wanted it to be in and stuff. Great. And now that I'm learning that there is a 403B option, I guess my question is what I did legitimate and still tax protected and legit and everything? And am I missing out on anything by not using the 403B since there's no employer match? Since there's no employer match, I know I'm not missing that. Yeah. Is there another advantage I'm missing?
Short answer is no.
Cool.
So you can save $19,500 into the 403B. You can save $6,000 into an IRA. So that would be the one drawback to using an IRA, like a Roth IRA, rather than your employer's retirement account, is the contribution limits are lower. But you might say, I'm not gonna, I only wanted to do $4,000 or $5,000 anyway, so it's not an issue. But the short answer is no, that the money in the Roth IRA will still grow tax-free, similar to how the Roth money in a Roth 403B would grow. You get the same tax advantages. So no, you didn't make a big oops. Cool. The biggest thing is smaller contribution limits, which may or may not be a problem. You can still save in addition to your Roth IRA into the 403B.
Okay,
so you could
and
still do it.
If I do that, is the money I already saved in my separate Roth, does that count towards my 403B limit?
Nope, it's a separate limit.
Oh, wow. But if I had put Roth, if I had funded say I put $6,000 into the 403B in a Roth, Then I could only do another 13,000 into the 403B.
You can do none the 19. So
Okay,
both,
cool.
you can do full both limits.
Okay, cool.
So you can do 6,000 into the IRA, 19.5 into the 403B.
Okay, so I'm not missing out on anything except for maybe having it like centralized.
Correct.
Okay, do you know how we go about starting or funding a 403B through the U?
I'm not sure exactly who you contact, but through the I don't know, someone else might know, but that you reach out to your HR group and they can put you in contact with the financial group at the university, and they can walk you through the process of opening the 403B.
Cool.
Great. Thanks, Jake. Great question.
No, yeah, thank you very much. I appreciate this whole presentation and your answer to my question.
Yeah, you bet. Any other questions come to mind? So like I said, we cover a number of financial topics. So some of the other areas we can talk about might be estate planning or like wills and trusts. A lot of people like to take a deeper dive into one of these topics that we talked about. We'd be happy to do that. I'd be happy to do that. Shoot me an email, give me a phone call, and we can set up a time that works for you. I know you guys are super busy, and do a quick call and sort out some of these details. Any other questions come to mind for anyone?
So Chad's information is here on the last slide, and we will be sending out the recording for your reference. It will be posted up to YouTube for a set period of time for you to go back and look at. We will be sending you a brief survey just for your feedback so we can continue to decide whether easy accessibility through Zoom or in person when we can meet in person again is a better option. So we wanted to thank you for joining us today. And if you have any questions, feel free to reach out to either the team who helped facilitate this, they were on the invitation, or to Chad, as he mentioned, if you'd like schedule some time to discuss with him your personal questions. So thank you very much to both Chad and Dr. Miller for joining us this evening. And thank you all for joining us. And hope you have a good evening.
Thank
Yeah,
you.
thank you very much. Appreciate it.
You bet.
Great, thank you.